The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you.
Welcome to Stocktake. My name's Gaurav, and with me today is analyst Nick Cummings. Hey, Nick.
Hi, Gaurav. How are you?
Not bad, thank you. And our Vancouver correspondent, Graham. Welcome, Graham.
Hey, Gaurav.
Nick, the filing cabinet's gone. What happened? Is it okay? I think everyone's asking. Everyone wants to know, is the cabinet all right?
It's in the spare room, much to the dismay of my girlfriend. But yeah, I got an interior design tip from John, and it's been replaced now with a beautiful photo.
That's a nice story.
I suspect surely the filing cabinet feels more corporate and business oriented.
Absolutely.
I think what really happened was that Nick got a bad result, and the filing cabinet took the bulk of his disappointment. The poor thing is probably in recovery somewhere in another room.
Yeah, I won't show you my hands.
Now, we're in the middle of reporting season, and as usual, all of our companies tend to result in clusters. So this week I've had about 15 companies report. I think, Graham, last week you were really busy, and Nick, you've got these quarterly reports for the American stuff. So you have that every couple of months, which is even worse. I thought what we do today is just do a round robin of some of the interesting results. We're far enough into reporting season now that we've had a good idea of what a good result and a bad result looks like. And there's some interesting observations to make. So Graham, let's begin with you. What have you bought for us today?
Cochlear, everyone's favorite hearing implant provider, which has a 60% share of the market, so you don't have very much choice, but it is a good company. And this past result was pretty good. It had a lot of difficulty through the pandemic because people weren't able to go to hospitals. They weren't able to get the implants. They weren't able to get tested either, which meant that there was kind of a shortage of the top end of the funnel for them. But yeah, it was a good result because all of that seems to have recovered dramatically since then. They had a 16% increase in the implants themselves, which is quite above average. Part of that was due to just the increase in capacity again, that they could get people into surgery. But also there was some catch up from the backlog of surgeries through the pandemic. So probably you couldn't expect that to continue indefinitely, but it's nice to see that they're getting back on their feet since the difficulty during the pandemic. And they also had actually a bumper. Go ahead.
No, could finish off, and I've got a question for you afterwards. But yeah, let's.
I was just going to say. Yeah, they also. I left you hanging.
Yeah,
they also had a bumper year for their services division, which that had a 16% rise in revenue. But there's a little bit of you need to kind of break that down a little bit, because they released a new processor this year, the Nucleus 8, which does kind of lead to a big increase in sales, but also because people knew that it was coming out, last year's sales were a little bit depressed because people think, oh, well, I'll just wait till next year before upgrading.
That sounds familiar. Are there lines forming outside hospitals, people queuing overnight to get that Nucleus 8?
I'm sure the demographic getting cochlear implants is definitely as crazy as Apple fans.
I wonder if what impact Taylor Swift will have ultimately on the cochlear market. You know, these concerts are just. I'm going to see Lauryn Hill later this year.
Oh,
and
cool.
That's probably not as loud as other concerts, but I've been to concerts that are just deafening. I do not understand why they need to be so bloody loud.
I thought you were going a different direction. I thought you were going to say that she's going to partner with them and beam her concert straight into people's brains.
Oh, that's even better. That's a better idea.
Way.
No, I thought there might be some subtle conspiracy between Cochlear and the recording industry. Just blast our ears and damage them and increase sales. If I was a tinfoil kind of guy, you know, if I was ranting here on my own YouTube channel, that's something I might go with. But fortunately, Graham, we are not. Look, the question I had for you actually was, I remember a few years ago, you were speaking about a Chinese competitor, and there was talk of a low-cost challenger out of Asia, specifically out of China, challenging Cochlear. Has that impacted Cochlear at all? Has that really been a nothing?
Not really. I mean, Cochlear's market share has actually been increasing very, very slightly, and you can't expect it to really get much higher. It's basically at its max in terms of market share. However, because they have such a lead on the rest of the market in terms of innovation, it doesn't get the same effect as, say, I don't know, a laptop that can kind of be cloned or something by a cheaper Chinese competitor, and then that gives people the option. With this, it's first of all very, very personal. It's literally being implanted in your head. So people aren't going for the lowest cost option anyway. Plus, it's being paid for by the insurer, so you're not really on the hook for a lot of the cost anyway. And Cochlear just has a huge lead in terms of getting the best devices, the best responses, the smallest devices, and all of that. So yeah, I don't think that they're at much threat from competitors. They account for almost all of the industry's research spending, basically.
Oh wow!
So yeah, they have a good lead.
Wow, that nuclear state must be something. Nick, shall we move on from Cochlear? And Nick, you've got a stock as well. I'm keen to hear about this one, actually.
Yeah, sure. So the one I'm bringing is Reece. It had a very good result if you just look at the numbers. So revenue was up 11%, excluding foreign currency, and profits were up about the same. But digging deeper, there was a clear mix between the first half and the second half. So the first half was extremely strong. The second half was about flat. And then management pretty much said that the second half trends have continued into the new year, into the new financial year. And this year's going to be quite weak. So to get to their 11% revenue growth last year, volumes were actually flat. It was all price increases. So as a distributor, Reece sits between the supplier and sort of a tradesman, and the tradesmen were quite busy and are quite time poor, so they accepted the price increases, and eventually we, the consumer, it gets all passed through the chain. But this year, volumes are expected to decline, but prices are expected, or price inflation is expected to moderate. So revenue could actually decline this year for the first time in a while. Yeah, and management also said they're still experiencing cost inflation, particularly in wages. So margins could get squeezed as well, which means there could be a fair earnings decline this year. I guess the good thing, or the optimistic view, if you're a Reece shareholder, there's still a huge opportunity in the US, and management are a classic founder-owner team, and they don't really care about next year's profits. They're looking at this business in 10 years. And they gave a quite eye-opening recap of the US division so far. So they acquired it 5 years ago. Since then, operating profits are up threefold, sales are up 80%. And now the goal is to actually expand more into the repair and remodel segment that's more resilient. That's where they've been so successful in Australia. And a player like Ferguson that we cover internationally has double the margins of Reece and are more exposed to that market. So any inroads there will be good for margins. Management strategy there is actually to roll out the Reece brand in the US. So they've already done this in California. So all the Californian stores are now branded Reece. And the goal by 2030 is to have every store branded as Reece and really go after the sort of smaller, not smaller suppliers, sorry, but smaller customers, so smaller tradesmen. Because at the moment, the concentration is residential and commercial construction, and they're dealing with larger suppliers, and that's why the margins are lower, as well as a lower store density as well. The disappointing thing, I guess, from my point of view, is this is a wonderful business, and we'd love to upgrade it, but it's at 40 times earnings, and earnings are going to decline, and it's just pissing me off a bit.
That's hard to believe, actually. I mean, that American housing market has just had a remarkable year when you consider the backdrop. James Hardie, I think, is up 60% of the year. All those American housing stocks, I think, are trading at all-time highs. It's remarkable.
It's crazy, and you've got players like Reece coming in saying your conditions are worsening. Do you think the share price is flat?
Is the same message coming from Ferguson as well, or is this specific? Yep. Okay.
No, yeah, it's industry wide. Yeah.
Wow, there are moments like that when management's trying to tell you something, and the market's just refusing to listen. I've had that experience as well. We talked about this before, but when TPG was rolling off its own infrastructure and onto the NBN, it was moving from being a reseller of its own services to a provider of its own services to a reseller of the NBN. And its margin profile was about to change dramatically. And for about 3 years, management was telling the analyst community, guys, our margins are going to fall. Our margins are going to fall. Don't expect these margins to last. And nothing happened. And then 1 year when their margins fell, everyone panicked and the stock price crashed. I just thought, what's going on?
Didn't see it coming.
Yeah. So all this efficiency we see in the markets is sometimes punctured by just dumbness.
Yeah, absolutely.
That's amazing. Okay, well, I'd like to keep an eye on Reece. That sounds really fascinating. We could see a big change coming from them. Okay, I've brought along one of my favorite stocks, which is Lovisa, which keen observers will know that we've kept on the buy list, even though the price has exceeded the official buy recommendation. And that's because I just wanted to give it a bit more cheeky leeway, because I actually think this is a fantastic opportunity, and one that doesn't come along very often. Lovisa is just on a tear. I thought these results were fantastic. All the numbers were great. Revenue was up. Margins are actually stronger. Gross margins reverted back to 80%. There have been 200 stores in the year. 200 stores. They're now in 39 countries, and you just compare that to where they were 3 years ago. 3 years ago, they had I think 40 stores in the US, and now they have 190.
They must have an incredible management structure to be able to handle that kind of growth rate. Like,
I can't get my head around it sometimes.
How can they operate so quickly, just finding the sites at that rate?
Well, this is what I struggle with sometimes. I mean, just think about the mechanics of this and what's involved. They have to have a leasing team getting somewhere on the ground and striking deals with 200 different locations. They have to have logistics in place, because these guys are famous for their very quick delivery and fast inventory turnover. So they need logistics in place to be able to supply inventory and turn it over all the time. And then they need some sort of data acquisition in the area so they can monitor what's selling and feed that back into their designers as well. I mean, all that happens simultaneously, it seems like. I don't, it's almost like magic. I don't quite understand how they're doing this. But do you
think that they're kind of taking a shotgun approach and then thinning out the poorly performing stores, or are they actually putting in a lot of research at the start to find the best sites?
I think there's a bit of both going on. You look at the store closure. So they closed 5 stores in the US. They closed 30 stores across their network. The company does do a bit of trial and error, and it's very quick to close down stores that aren't working. And that's something I really like about the business. They don't sit there and operate loss-making stores. If it becomes apparent that the store isn't working, they quickly shut it down. They famously left Spain altogether. And this year they re-entered Spain with a single store. And I just think they might be testing that strategy again with different locations and maybe different strategy. It's too big a market to really ignore. A couple of things really stood out for me for the result. One was that this store growth, I think it's 200 stores per year is sustainable. The American network is only 190 stores. It's now the largest territory in that network. And I think you can add another 0 to that pretty comfortably over time. There's a lot of very large markets that have a tiny store penetration, and that's clearly them testing the market and then preparing for much stronger openings. Mexico has, I think it was 7 stores. Italy has like 4 stores. These are big markets that have tiny store footprints and can potentially increase a lot. And the other thing operationally was that Lovisa used to, in Europe, they used to outsource their logistics, and they've now built a large logistics warehouse, a distribution warehouse in Poland. And that should make it easier for them to roll out stores all across the European continent. Mm-hmm. And they're really positive that they've taken the investment to internalize logistics. It shows a real commitment to Europe. And I think Europe sometimes gets forgotten inside that amazing network.
That was one market that surprised me, actually, Poland.
Poland, yes. That
going from 1 store to 18. it just shows you that they can really accelerate that rollout when it is working.
And I think this is the key to wrapping your head around this. I mean, it's not easy buying a retailer with no obvious moat at 35 times earnings we're talking about. But what you have to realize is that the company is just continuing doing what it's doing. We're not actually asking the business to do anything new. Nothing changes. They've shown that they have the logistical and managerial know-how to grow the network. They've shown that they can open in markets across cultures and across geographies. And from my point of view, we're just doing the same thing. And when you run the numbers through, that PE comes down awfully quick. I think in 2 years' time, when I ran some basic assumptions, it's back at 20 times earnings, so that seems perfectly reasonable to me. I think there's a long runway here for growth. I'm still pretty positive on it. I think the team is probably less. There's probably more controversy about how large and how successful the Visa can get. But I will disclose it's my largest position by some way. Personally, I parlayed a lot of coal gains back into La Visa. It's the only stock I can think of where I bought that at $2 something, and I bought it at $20 something. And
still felt you were getting a good deal.
Yeah, well, I can't think of any other stock where there's a 10x difference in my purchase price, and I'm still really, really excited and happy about it. So,
I kicked myself with that one because I remember when it was. I probably came a bit later to it when it was in the $3, but I just remember thinking it kind of is beyond belief a little bit, and so I didn't do anything with it. But then it lived up to all those claims and expectations. And now it feels the same. It's like it's a bit beyond belief, but I was mistaken the first time. So
yeah, get yourself some La Visa, Graham. The market hated the result, I've got to say. I don't understand the reaction to this result. The share price was down 6% on the day, and it was because the first 7 weeks of the new financial year, the company recorded a decline of same-store sales growth of about 6%. And I think that freaked the market out. And they did speak about slower sales growth throughout the network in this period. And I think that did freak the market out. But, when you think about what was going on, we're clearly going through a bit of a cyclical funk internationally. And in the last period, we're cycling numbers that included a big post-COVID boost. So, it's a tall order to match that growth. And I was actually okay with a -6% figure. I think there was some prospect it could have been in double digits, and I still would have been okay with it. But for the decline to only be 5-6% was fine. Yes, I'm pretty happy with this one. I thought it was a great result. Don't know. I think the market's got it wrong. I'm just going to say it. The market's wrong about it, and I'm more than happy to have a big weighting into it myself. Any questions? Let's move on.
Sounds good.
Graham, what's your number 2?
Number 2 for me is Sonic. It's one of our buy recommendations. Yeah.
Yes.
It didn't have. Well, I don't know. It's another case where the market kind of thought it was a bit worse than I did. I think its net profit halved, which
that sounds pretty bad so far.
So we're not off to a good start. However, it was all kind of anticipated, I think, that almost all of that decline is down to a reduction in COVID-related testing. So nobody should have been surprised by that. But if you kind of strip out the COVID side, the business is actually doing better than at almost any time, I think, in its history, just about. So its kind of base pathology volumes were up 11%. Which this is a business that typically in mature markets is just going to grow at 2%, 3%, maybe 4% if you're super lucky. So to grow in double digits is, I think, a pretty impressive result. So I feel like
Graham, was that because they included new territories in the network, or was that a bounce back from COVID? Or maybe
part of it is because, well, it's not to do with COVID so much.
Okay.
That was the excluded revenue.
Yep.
But there are some acquisitions. I mean, they do have an acquisitive model. So some of that is through bolt-on acquisitions of smaller clinics. But even if you strip those out, it's still 7% growth. So still well above their historical kind of norm on a like-for-like basis. So yeah, I think it was a good result disguised by an ugly headline, basically.
I was looking at briefly integral diagnostics as well, and that's another one where I would have expected stronger growth to come back. It got knocked around in COVID, and I think for very obvious and understandable reasons, but the bounce back has been really slow. Is that something that's impacting Sonic? The other one I'll point out is Pacific Smiles as well. Also, the bounce back has been slower than I would have thought. It seems to be something in hospitals or healthcare. Everything is it's not like retail where the return from COVID has been really swift. It seems to be a lot slower.
Yeah, I'm not sure about Pacific Smiles, but in terms of radiology, and Sonic is a direct competitor to Integral, it has actually, the growth rates have kind of normalized a bit since COVID, but I think both of them and the whole industry broadly was affected by staff and nursing shortages. So it wasn't they were dealing with the same kind of capacity as they had pre-COVID. But from what I can gather from these results, from Sonic in particular, that a lot of that is starting to alleviate. So it wouldn't surprise me if you look a year or so out and it has actually gone back to kind of a more normal level of volumes.
I remember reading some research a few years ago that essentially all these volumes would just come back and there'd be pent up demand once it opens. But it's probably the wrong way to think about it, because when you lock people inside for a year, there's less car crashes, there's less sports injuries, there's less all of that. So it doesn't actually make too much sense that there's massive pent up demand. There will be some,
but
it's
a good point.
Yeah,
you're right. For those expecting the normalization or a kind of revenge testing, I don't think that's you're right. When you think about it, it doesn't make a lot of sense, does it?
That's probably the case for pathology, but for radiology, a lot of their stuff is either pre-surgery or diagnostic because you've got cancer or something like that. So I'm not sure how much that would have been affected by being stuck inside. There's probably some degree of it, but
I do have a tip for Sonic management, should they be listening. What my local dentist has done, he's offered Matchbox cars for all the kids getting their teeth checked. And we have gone to the dentist in the last few months more often than we have ever gone, because my boys just want to go to the dentist all the time.
Collect them all.
I've got a toothache. We have to go see that dentist, and now we've got a huge collection of Matchbox cars for it. And I feel as though, I don't know, maybe that will work with Sonic. Throw in something. Come and get tested. Might work.
Maybe they should be giving it to the referring doctors and encouraging them that way. They can't give financial kickbacks, but maybe they can give Matchbox cars.
Nick, I was going to say you're number 2, but that sounds pretty nasty. How about your second choice?
Just before that, we'll just take a quick short break.
Yes, let's do that. Thank you, Nick. The responsible adult in the room. Yes, let's take a quick short break.
If you like the sound of our investing approach and aren't yet a member, visit intelligentinvestor.com.au to take us on a free 15-day test drive. Get immediate access to all of our current buy recommendations, model portfolios, and engaging educational research tailor-made for people that want to manage their own money. That's intelligentinvestor.com.au for a free 15-day trial. No credit card required.
Yeah, so my second one is WiseTech, a company we don't formally cover, but a company we've written up a few times as an ideas lab. We'd love to own this business. It's just wonderful, but the valuation is our buy price is so far away from the current share price. It's not worth doing. Its result, it actually fell 20% on the day of its result. Unfortunately, I want it to be down a lot more, but it was just a case of the market getting way ahead of itself with expectations. So revenue rose 30% this year, and everything looked very good in the numbers. Cash flow was great. They acquired a few businesses which will kick into earnings next year. But the forward guidance has the business slowing down from around 40% revenue growth in their core CargoWise software down to 19%. And they called out that there was some industrial slowdown, which they do get some revenue from volumes, so that is coming back. But the market just can't, or the share price just couldn't support a valuation and the disappointment that sort of followed after the release of these numbers. Brokers actually downgraded their numbers by about 35%. And the share price response was only down around 15%. It's back to where it was in July.
Yeah, it's back to where it was, right? Yeah.
Yeah. It now trades at 90 to 100 times earnings. And compared to where we had it, when we looked at it last November, it was trading around 70 times earnings. And I was like, if this business falls back maybe to a $40 share price, it could look really, really interesting. Because
what's amazing about that number, Nick, and you pointed this out internally when you were presenting the stock, was that this is not a business that needs to scale. Margins aren't going to increase. We're not going to see higher leverage. It's already at max margins. It's already generating the returns it's going to generate.
Yeah, that's right. I mean, revenue growth this year was 30% and NPAT growth was 30%. So it's been like this for a number of years. They actually said margins were going to fall next year because they're swallowing these lower margin acquisitions or digesting these lower margin.
Have you mentioned the Matchbox car idea? That could work.
I haven't.
Have you got shares in Matchbox, Gaurav?
Yeah. No, but it was just, I think Reece and WiseTech, the reason I brought those two stocks, it really highlights that I think the market is getting very, very optimistic with a lot of these quality businesses and willing to pay unbelievable multiples for them, despite weaker results. Like, I think if you ask anyone that if, would Reece's share price stay the same and its PE actually increase when earnings are coming down 6 months ago, they would have said no. And the same thing for WiseTech if they were going to miss earnings expectations by 30 or 40%. But they are, and it's just ridiculous. And it's, as I said before, it's really pissing me off because it's giving us less opportunity to buy some really high quality businesses despite short-term disappointments.
Let me play devil's advocate for a second here, Nick. Is there an argument, and I know management have claimed this as well, that this isn't just a dominant business, this is a potential monopoly business, and they could actually take all of industry profits if the idea works. And that's why you can justify these crazy multiples for the stock.
It is, and that is the argument. The founder, Richard White, has previously talked about they want to become sort of ubiquitous. They want to become the Microsoft Office of the industry, and they do think it is a winner-takes-all industry. And on the optimistic side, there was there were points in this result where you go, actually, this WiseTech could be the winner here. I mean, they signed the number one global freight forwarder, Kuehne+Nagel. They expanded their relationship with FedEx. They now have, I think, 47 of the top sort of global freight forwarders signed up on CargoWise, and those rollouts will increase over the next few years. So when they do sign a customer, it takes 5-6 years, sometimes even a decade, to get all the customers' volumes onto that software. And then that means revenue growth is usually quite good throughout that period. So you're right, it could be a winner-takes-all market, but you're paying an awful lot for it. And the revenue and at least the top line growth is much slower than probably what you would need to justify that multiple.
Yeah. So that argument that it's a winner's take all, that's a possibility, but it's been priced in as a certainty.
Yeah, that's it.
Yep.
I mean, to get this back to a reasonable multiple by the end of the decade, you need to price in some very optimistic assumptions. And there's just not too many businesses throughout history that actually end up doing it. Yeah.
Nice one. Okay. I remember when you presented that to the team for the first time, it really, that's when I think all of us realized that there is something to WiseTech. We've been a bit slow on the uptake of that one, but glad to have it on the radar again. My second stock is Aussie Broadband, which I thought is in the running for result of the season for me. It didn't surprise, it met guidance, and it shouldn't have been a huge shock to anyone following that business. But the reason it was so good and the reason why this particular result is so important is because Aussie Broadband is in a bit of a pivot phase. It's doing something quite different. For its entire history, and it's been around for almost 20 years, this has been a seller of NBN. It started in regional Victoria. It's fought off 90 competitors to be the number 4 reseller and the fastest growing one. It's a collection of the highest margin customers in the entire industry, and you can see the damage it's wreaking on its competitors, because Telstra makes very thin margins and is barely profitable in broadband. Ditto TPG and ditto Optus, and the reason is that Aussie is just scooping up the most profitable customers. That half their subscriber base is 100 plays more than $100 a month, and those are the ones that are the most sought after customers in the industry. And I think the NBN average is something like 14% or something. So it's a you can see where those high margin customers are going across the entire NBN network. They're going to Aussie, but the company has recently been pivoting less towards that NBN market and more towards wholesale services, enterprise, and government. And it's relying on wholly owned, newly built fiber assets to make those services attractive and to attract high margins. And it was quite a risky move, because if the business wasn't able to make that pivot, it would have spent a lot of money on fresh fiber assets for no benefit. And we needed to know whether this move was working or not. And this was the result to test that thesis, and the result came back, and yes, it is working. The idea is working. They are making terrific traction in the new areas of focus. And to be honest, for me, who've been following the company since IPO, this is not a surprise. I'm so impressed with this management. I think they have shown that there's no obvious moat around this business, right? There's nothing that they do that the competition cannot do or a startup cannot do, but they just do everything better. And listening to, actually, Telstra these days actually has pretty good management, so it's a poor example, but I'll shout out to Optus, because they are just, I think they're all at sea. That they Singtel's results shows that the Optus Australia is that it's quite a large business, but a surprisingly low profitability one. And TPG's in all sorts of trouble. They're just not scaling that mobile network, and they're not making as much money as they used to on the NBN product. So they're in a trouble as well. And I think Aussie Broadband is the one in the industry that's now challenging the big guys and is scooping up a disproportionate amount of the profit pool in the entire industry. And to me, it looks a lot like Macquarie Telecom, Macquarie Technology Group, which started off in conventional telco and moved into specialized high margin services, enterprise and government. And that's now the bulk of their business. And it's a high margin, high moat business now, whereas in the past it used to be a sort of low margin, low moat business. And I think that transition, you can see that happening with Aussie Broadband. And it looks like they've got now the physical assets, the financial capability, and the management skill to complete that task. I'm really impressed with this one. I own it, I should say, and it's in the IA funds as well. But great result, and a really important one. If we had found out in this result that transition to the new products was not working, if they had not hit it out of the park, I would have been tempted to actually cut and sell at that point. I think that's almost a broken thesis. So it was very encouraging to see that things are working with the strategy.
Aussie sort of fits in one of those baskets for me that doesn't really make too much sense. So you're always taught at business school, or even talking to other investors, you're supposed to find a high quality business with a large moat. But this doesn't have one, and neither does Dicker Data, neither does Mainfreight, but through superior customer service and management, and just eking out a profitability where others can't. Like Optus, I think you mentioned, was what, 50 million in operating profits, or it's just crazy.
It's crazy low, isn't it?
Yeah.
And last year, Telstra, as I say, the management quality of Telstra has really improved over the last few years. But last year, Telstra made less money selling NBN than Aussie Broadband did. And I just think
That's astonishing.
That's just astonishing, right? Just astonishing. But this year they actually did a lot better. And as I said, Telstra is no longer a laughing stock because I think it is properly, that upper echelon management is quite good. But that's new. That hasn't happened for 20 or 30 years. And so we can, we can sort of have a giggle about that. But Nick, I think what you said about customer service is quite important. I think the industry and investors think customer service is just a matter of saying please and thank you on the phone, or sending you a birthday card, via email or something like that. I don't think they quite grasp what customer service means. And for Aussie, customer service isn't just saying please or thank you. It's a demonstration of a cultural superiority that runs through the entire business, because everyone who answers the phone in a call center has the training and the authority to follow almost any problem through to its end. There's no, may I speak to a supervisor, or we'll get back to you, or can I check this out? Everyone in that call center can handle almost any problem with maximum authority. And you go through the entire business, people working at any level are almost little autonomous units. And it says something about the culture of the place, the training provided, and the quality of the people it's attracting, that it's able to operate that way, because Telstra definitely cannot operate that way. And that's why when people say, oh, but Telstra can do customer service, yes, they can say please and thank you, but they cannot offer that level of the real deep service that Aussie can, because it's a product of culture. It's not a product of language or manners.
And I think people probably underestimate just actually how big that moat is. To change the customer service in an organization like Telstra would be a monumental task. It's just not going to happen.
The one that is nowhere near is TPG, which has been the traditional challenger brand. I mean, look at their NPS scores, their net promoter scores. It's just miles off. I mean, Telstra deserves some credit. We don't want to be picking on Telstra because they actually lifted their scores, and I think they have done better. But yeah, I really fret about the future of TPG. I think they're certainly not the business they used to be. I wrote an obituary for TPG recently. So if you want to shed a tear of TPG, you can go read that. Right. I think that's 2 each, isn't it, fellas? Yes.
Yeah.
Got my maths correct? Yes, I think that's right. Now, before we sign off, are there any questions we've picked out from the comments? I do have one, but I'll give you guys a chance to go first. Graham, do you have one?
Yeah, I do. This is for Steve for reminding us that we should do some questions at the end of the show.
Thank you for reminding us.
Yeah, thanks, Steve. Yeah, Michael M asked a question a little while ago, which I thought was quite interesting. He said, how can a buyback make sense if intelligent investor doesn't see the company itself as a buy? And I thought that was it was just an interesting question, because it's actually 2 questions in one. When do buybacks make sense? And also, what do our price guides mean? So in terms of our price guides, I think that is kind of worth going over, because there can be some confusion. When we're saying hold on a stock, it doesn't mean that we think that it's fully valued. That when we say buy, it's kind of obvious that we think the stock is undervalued. But when we say hold, that's not that we think it's fully valued. It means that we think it's slightly undervalued and that we're happy to hold. But in the same way that say a $10 note could be underpriced as a $7 note versus a $9 note or something or other, there's a difference in that margin of safety. We might think that it's only worth buying the $10 note when it's being sold for $7, giving a big margin of safety. But that doesn't mean that it's silly to buy it at $8 or $9. You're still getting a deal. We just don't think there's enough of a gap there. So yeah, that's the price guide side, that just because we say hold doesn't mean we don't like the stock or we're not happy to buy it at that price. It just means we think it's worth waiting for a bigger margin of safety if you're going to add it to your portfolio. The other side of it is when buybacks make sense. And that's basically whenever the company is able to repurchase its stock at a lower valuation than its intrinsic value actually is, and that it's got the financing capacity to do it. So if you've got, so in that case, we can say that, yeah, the buyback can make sense if it's just a 10% discount to what it's worth. And management is probably going to have a better idea of that than outsiders because they've got all the inside information. So they can accept kind of a smaller margin of safety than an outsider, I would say. So kind of putting those two things together, yeah, a buyback can make sense, even if it's in hold territory. If it's in sell territory for us, then we probably aren't going to say that it is smart to for the company to be buying back stock. But while it's still a hold, that can still be perfectly fine and add value to shareholders who are hanging on. What do you guys think? Are you guys in the same kind of camp?
I'd add one more thing to that, is that we have lots of competing uses of capital as private investors. There's a whole universe of stocks and assets that we can buy. So any idea needs to be particularly attractive to get a spot for our incremental dollar, whereas the company, there's only a limited pool of possible investments they can make, right? They can pay a dividend, buy back stock, or invest back in the business. And so those opportunity costs are very different for the business and for us as individual investors. Anything to add, Nick?
No, I think you guys have covered it well.
Thanks, Graham. Good question to pick up, and good question.
Thank you, Michael.
Look, I know there's a lot of questions on my articles. I find it very difficult to go through the comments while reporting season is on. I can't do multiple things at once. I just find it mentally challenging. Sorry about that, but I will get to them maybe next week when I'll set aside a day and I'll just go through some of those questions. But one I wanted to point out here was there's been quite a few comments about Illumina, and specifically making comparisons between Illumina and New Hope and Illumina and Whitehaven. And I think the inference seems to be that, Whitehaven and New Hope have done spectacularly well. And this is another resource commodity business, and it's destined to do spectacularly well as well. I'm not going to pretend to be falsely modest. We have a stellar track record on resource stocks. It's got to be one of the best in the industry. Like we do it really, really well. But the reason we do it well is because we do it so selectively. We don't do it very often. Illumina, let me be clear, is not the same opportunity set as those coal miners. This is a far more speculative business. When we were buying those coal miners, it was a traditional cyclical funk. From my point of view, I thought we were buying pretty decent assets at a time when the market was funked out. There's nothing overly clever about that. I don't think all you need is the stomach to do it. You don't need any real insight, or you don't need any special intelligence. You just need the behavioral and the stomach, really, as I said. But that's not the case for Illumina. I mean, it is a high quality asset base, and the commodity price is bombed out. But there's another layer of complexity with the regulatory risk. And that is something that, your stomach isn't going to help you with that. Your analytical skill isn't going to help you with that. That's a risk we're just taking on. We're taking that on. And the reason why it sits on the buy list, I note that it's a speculative buy now because those regulatory risks have increased in the last few months. It's a speculative buy. And that's because if the WA government does not grant those licenses, the business's low-cost status will be challenged. It will still be able to access ore. Volumes shouldn't be interrupted too much over the next decade or so. But it's really about the cost profile, because the new areas provide higher grades, and instead the business will be forced to continue to mine lower grades. And so you have a permanent shift in the cost of this business. And I can't handicap those odds. Why is it on the buy list in that case? Because WA, the only reason that remains a spec buy still and not a hold or a sell, is because WA is the best mining jurisdiction in the world, bar none. And if you look at the history of WA decisions, they've almost always favored mining over not mining. The economy is built that way. The political culture leans that way. And so I think the odds are in our favor, but they're not. There is a marginality to this. This is not the same thing. This is not a no-brainer. This is not a traditional buying good assets when the price is funked out. There's a new layer of complexity. So I really want to be very clear about this, that Illumina is not New Hope. There is more uncertainty about its outcome, and hence it's a speculative buy. So please act accordingly. And I made a special note in that review to point out that we should stick to very carefully to those limits. I don't always stick to limits, but I certainly would be sticking to those alumina limits. So please tread carefully with that one, because it is not New Hope or Whitehaven.
It's 10 times better.
Yeah. So Nick, you can see you sweating there. You've parlayed your mortgage into alumina, haven't you? How many times have we spoken about this? Hey, listen, I think we're supposed to break one more time for a break. So let's do that and we'll come back and say goodbye.
If you enjoy our approach to investing but don't want to manage your own money, check out Intelligent Investor's range of managed funds, including income, growth, ethical, and international options. Decades of research and experience is distilled into the management of these 4 managed funds, each focused on achieving outsized investment returns. Check out our performance, track record, fees, and approach at intelligentinvestor.com.au/funds-overview. That's intelligentinvestor.com.au/funds-overview.
All right, now that we've forced you to listen to a commercial break, it's time to sign off. Thanks very much for joining me today, fellas. Graham, pleasure to have you on as always.
Thank you.
And Nick, missed the filing cabinet, but nice to hear from you as well.
Thanks very much.
For everyone else, thank you for listening.